Hi everyone, and welcome to Financial Basics, where we make money grow with you. Today I want to discuss putting money into the stock market and trying to time the market and the consequences of that. So I want to look at a few definitions. I want to look at what the actual data shows, looking at the Dow Jones and the S&P 500. I want to look at what happens when the markets are at the highs, right? So the worst time to invest, according to a lot of people, is when the market's at an all-time high. What happens after the highs, typically, at least historically speaking? What is the probability of positive returns in the market if you invest on those all-time high days? What is the impact of this on your portfolio? What about the performance after the worst days, right? And then just asking yourself a couple of questions around going in and out of the markets or out of your investments. And then I want to talk about a concept called Mr. Market, and then just market jitters, right? So there's just the psychology of investing and when to invest and when not to invest, and how to tackle that as an investor that is looking long term, that's looking 30, 40, 25 years out, decades out into the future, and trying to go, how much does this actually impact me? How much does this actually matter? And even if those timelines are a lot shorter than decades, what are the consequences for that? What happens if you're only looking at 1 year or 5 years or even 3 years? So for definitions, I want to just talk about a couple of ways to put money into the market, right? So one of those ways to do that is value averaging. This is where you are adjusting how much you invest depending on the present value of your investment. So you could say in this scenario, for example, by the end of Q4, I want 4,000 in the market. And then you're constantly readjusting that up or down depending on the current value of your investments, right? So in the first quarter, the price is 10. You're buying 100 shares. It's going to cost you 1,000. So you've got 1,000 in there, and for Q1, your goal was 1,000. By Q2, the value of the shares has now increased to 1,250, which means you're aiming for 2,000. You have 1,250 in the market already because the value of those 100 shares is now increased. You only need to put up the 750. And that translates to an additional 60 shares purchase, meaning you have 160 shares valued at 1,250. For Q3, the share price backs off a bit, goes down to 8. You now need to adjust, and you need to put 1,720 in to get your 3,000 overall value at the new 8 price point. And the same with when the move goes to Q4, it's back to 10. You now need an additional shares purchased for only 25 at £10 at 10 each, so that you can bring that total value up to 4,000. And you can see there how the current value of the shares actually determines how much you're actually adding at each step. Dollar cost averaging, a lot of people are very familiar with this, particularly in the finance community or the FIRE community. And it's basically the practice of investing a specific amount of fixed dollars on a regular basis, regardless of the share price. So if the share price goes up, you take $1,000, you're buying fewer shares. And if the share price comes down, you're still investing that 1,000, but you're getting more shares for it. So you end up buying more shares, right? So the number of shares that you actually own consistently goes up, but that just depends on the share price. And this is fantastic if you want to just build that habit of consistently investing a specific amount into the market at a specific point in time. So the other option to talk about is just lump sum investing. So what do you do when you have 10,000 or 20,000, a substantial amount of money available? Do you put that into like some sort of, I'm going to distribute this out over the next 12 months, or do you put all of it into the market in one go? So lump sum investing would be putting that all into the market in a single go into your investments. So instead of spreading it out over multiple periods of time. And then I just wanted to give a small mention to continuous investing. So this is distinct from dollar cost averaging or lump sum investing. It's more a blend of the two, where you are investing as soon as the funds available are available, irrespective of the amount that you invest. So it adjusts, but it adjusts based on your available funds, and it's not tied to a specific amount or a specific value in the share price. What ends up happening is people actually get these two mixed up quite a bit between this and dollar cost averaging, because if you're earning a consistent paycheck, what ends up and your expenses are generally similar every month or every time period that you receive a paycheck, then you end up doing dollar cost averaging because the amount of available funds that you have is the same as well every month. But if a windfall or shortfall occurs, the amount should actually be adjusted up or down depending on how much you actually have available, right? So it can be sort of considered a blend of dollar cost averaging and lump sum investing, where actually you're just going, fundamentally, I want to put as much into the market as possible for as long a time period as possible. So let's just dig into some of the data. This is the Dow Jones Industrial Average for the last 100 years. This is a linear scale of that, and you can just see how it's constantly going up. There are major points where it dips down, but to be able to predict when that is going to happen at some future date or even tomorrow, obviously that is not something that's possible looking at a graph like this, and with the data that we have available, it's very difficult to do, if not impossible. So this is the logarithmic scale of that same graph. So you can see there the increments as you go up. Starts at 62.5, jumps to 125, jumps to 250, to 1,000, right? So you can just see that constantly rising, and that demonstrates the ups and downs, the movements in the graph a lot more clearly, and what those values actually show. It becomes impossible to take data like this and make useful financial decisions in terms of when to invest and when not to. And even if the market is at an all-time high, you aren't in a bad place if you are investing for the long term, if you are thinking about things down the road and you're not worried about the movements of the share price. Here's the S&P 500. This is from 1925 onwards, and you can just see the same sort of behavior. That graph is just shooting up. There are many points in this graph where it is at an all-time high relative to the historic previous points on the graph, and it becomes very difficult if you've made a decision to only invest when it is not at an all-time high. So looking at all of the things going on over the last 100 years, there was a huge crash in 1929. You had the Great Depression, you've got the World Wars, you've got the Vietnam War, Cuban Missile Crisis, there's Black Monday, you've got the Reagan era, you've got the tech bubble in there, the housing crisis from 2008 more recently. the pandemic is barely a blimp on this radar, on this graph. So you can really see how all of this looks, and it makes it really difficult to decide when should I have my money in the market and when should I just take my money out in order to reinvest it at the right time. So let's just talk about the highs. So the S&P 500 has all-time highs really commonly. So between now, roughly now, between March 2024 and the 1950, there has been 1,250 times that the S&P 500 has been at all-time highs. And I'm just looking at the data by decade. So you can see it's 137 times in the 1950s, 35 times in the 1970s, 13 times in the 2000s. The 2010s see 242, 1990s 310. And really what that's showing you is that it happens fairly often, right? So if it's happening 100 times in a decade, that means it's happened 10 times in a year on average, which makes it really difficult to decide, well, it was at an all-time high yesterday, but it's at a new all-time high today and a new all-time high the next day. And you're really sitting there just deciding, okay, when do I put my money back in? When is a good time to do that? Or when is the right time to take it out? So what actually happens 1 year, 3 year, and 5 years after an all-time high? How frequent does the market correct itself, right? How frequently does the market drop after that? So they've looked at this data. RBC did a huge study on this, really going all the way back, I believe, to 1950. So 1 year out, and this is now what has happened to the market in the past 12 months if you had put your money in on the worst day, right, or on the all-time high day. After 1 year, there's and this is looking at, is the market 10% lower than what it was at that all-time high? It's not 20%, not 50%, not 40%, up to 10% lower, right? So greater than 10% lower. So after literally 12 months of an all-time high, there is a 9% chance between now and 1950 that the S&P 500 would have been down more than 10%. So you have a 91% chance that is less than 10%, or the market is high, right? Is above what it was when you put the money in. If you want to look at 3 years out, you're talking about a 2% chance, 2%. And 5 years out, 0. It has not occurred where the market after 5 years is 10% or more lower than what it started with 5 years ago. And if you look at the 10-year timeline, it has always been higher. So not just the 10% margin, it has flat out always been higher. So looking at positive returns, this is the S&P 500. This is also since 1937. So you can see there, just looking at those timelines, 1 day, 1 month, 3 months, 1 year, 3 years, 5 years, 10 years, right? And this is now investing not when the market is at an all-time high, but on any day, right? So if you're investing at any random day, the day after that, there's a 53% chance you're going to be up. A month after that, there's a 63% chance you're going to be up. After 10 years, there's a 97.3% chance you are going to be up. After a year, 77%. What is the impact of this on your portfolio, right? So investing at all-time highs versus investing any day, right? So Your average 1 year return, if you only invested all-time highs, you ignored all the other dates, not only could you predict when it was all-time highs, but specifically when it's not all-time highs. So you have perfect information here already, but you're only investing when the markets are at those all-time highs. The difference in your return, the impact that this has on your return, is minuscule relative to what the market does after a period of 1 year, 3 years, and 5 years. So you're talking about losing maybe 1%, maybe 1.5% if you are investing at that worst possible date. And this data again was 1950 all the way through to March 2024. Let's take a look at the worst possible days, right? And so this isn't all-time highs, but this is if you were to invest where that morning you put the money in and the market just hits an absolute real turbulent day and really goes down to the negative, right? So we're looking at the worst days since 1960 for the S&P 500. And you can see them there. If you had invested on the morning of the 16th of October 1987, your investment would have been 20.47% down that day if you had invested in the morning and you had waited until the end of the day. But after 1 year, you would have been up 23.19%. Doesn't that just blow your mind? And if you look at those figures, there are some wild days there where 2020 down 11.98%. But if you had waited a year, you would have been up 66%. Same with the next one, down 9.51, up 58.96. I wish I could get returns like that. I no longer care about what happens on that day if I'm investing even with a 1 year timeline. And that 1 year timeline, you get that bounce back in the market and you get a 66% return on your investment after 12 months. Absolutely insane. 2008 financial crisis, worst day, 8.93% down. A year later, 12 months later, and you are up enormously. Just insane returns when you think about it like that. With an average return across all of these bad days, because of that bounce back in the market, you are talking about, on average, 30.29%. And your return actually gets worse if you look at it as a per year return rate over 3 years and 5 years and 10 years. And the reason for that is because you're not getting the bounce back in the market. You're getting more consistent, more average return, spreading it out over a longer period. So your return actually goes down across that. If I knew when these worst days were, and I had any line of sight in terms of how that market is going to bounce back, I wish I could invest on these bad days. It would be the best time to invest if I could just pick and choose when to enter the market, when not to, and get 30% returns in the market, just the normal S&P 500. If I could just pick those dates and just go, okay, I'm going to invest in this day, and I know in a year's time I'm going to be 30% up. But across even 10 years, you're looking at 11.37%, and it feels very much normalized and very much in comparison to what the market does on average, where those bad days don't affect your overall return on investment. So there's the graph showing those timelines. You might be down 20%, or 10% or 5%, whatever the case may be on that day. The 1 day return is the blue. And then you see those timelines for 1 year, 3 years, 5 years, and 10 years out. All of them positive, all of them good. Some of them quite extremely good, 60% return after a year, 50% return after a year. So when you are going in and out of the markets or in and out of your investments in this way, you have to sort of get multiple decisions correct. And that makes it really complicated and really hard. It's like flipping a coin multiple times, trying to get heads at every stage. When do you get back in if you're cashing out? When to get out in the first place? So both of those things play an enormous part, right? Like the market is good, but could it be better? How are you going to feel riding that roller coaster if you think, okay, the market's at an all-time high, and then it just smashes through and goes through, multiple weeks where it's sitting at the all-time high, where it's just constantly going higher and higher and higher, right? You could easily get a 10, 15% rise after you've decided to take your money out. And the same in reverse, right? So it's up and then it comes down by 5%, and you're like, okay, is now a good time to buy? Is now a good time to put my money back in? Or should I? And then if you put your money back in, it could go down another 10% the next day. It could go down another 3% the next day. And you're sitting there going, well, I should have waited another day. But it could have just as easily gone up by 10% the following day. And you could have sat there going, okay, well, I'll just wait a bit because it might come down more. So deciding when to pull it in, put it into the market and when to take it out becomes really, really complicated. And by going to the sidelines, you are missing the potential rebound, which happens almost literally every time, at least historically speaking, not even almost. And you could not just be missing out on the potential rebound, but all of the potential growth, right, on that money going forward. So you're getting that exponential growth, but you've lost out on this 5%, 10% rebound. And the consequences of that really push forward all the way into your retirement. And Warren Buffett made a wager. He put $1 million bet on this back in 2007, that an S&P 500 index fund would outperform active stock selection of hedge fund managers over a 10-year period. And the hedge funds lost this bet. They couldn't match the S&P 500 by a substantial margin. And the thing to note here, and the reason why I'm including this in this slide, in this presentation, is because what those actively managed funds are actually doing is they're attempting to time the market. They're attempting to decide and make decisions based on all of the data and all of the money and all of the resources that they have available. They're attempting to figure out when to put my money in and when to take my money out. They're struggling with this decision. They're struggling with the decision on when to pull out and when to leave it in. And the consequences of that is you end up losing out on that huge motion in the market, and losing out on even a few good days absolutely smashes your overall return. So Benjamin Graham spoke about this in his book, The Intelligent Investor. He talks about Mr. Market, and Warren Buffett has spoken about this guy as well, this hypothetical Mr. Market guy, calling him the psychotic drunk. And every day he shows up and he tells you what your investments are worth. And in addition to that, he offers to either sell you more or buy what you have. And you have to make that decision every day on whether he's being reasonable or not. And sometimes he is spot on, right? Sometimes you look at all the data and you look at the company and the underlying value and you go, okay, this appears plausible. This is justified. This is a reasonable price. But often, on the other hand, this guy, this Mr. Market, just is a little bit the psychotic drunk, and he'll show up with values that are either completely ridiculous, i.e. really low, or just, absolutely insane in terms of overvaluing the investments in the market. And you get to decide if you want to sell to him when he shows up, or if you just don't. And if he quotes you a ridiculously high price, you might want to sell. And equally, when his price is really low, you might want to buy. But he is there ultimately to serve you, not to guide you. And that's really key. You have to understand what you're investing in, and you have to understand if these are long-term intrinsic things that you believe will return the investment. So as long as the underlying businesses are good, then you are doing value investing. You are making investment decisions based on the core values of the companies that you're investing in. And the great thing about Mr. Market is he doesn't mind being ignored. You can tell him to go away and leave me alone, and you just want to enjoy your day and have some coffee or whatever the case. And he just be like, okay, no problem at all. I'll come back tomorrow with a brand new price for you. And if it's uninteresting, that's fine. He's just going to be back tomorrow. That's not a problem. He is there to serve you and not to guide you. I also want to talk about market jitters. This is just really psychology. And when markets are sitting near all-time highs, many investors still can't help but feel uneasy. They feel like, oh my gosh, should I take my money out? If I leave this money in, it's definitely going to come down at some point. And some investors decide to actually remain in cash and wait for a large correction before they reinvest that money. And oftentimes it never actually comes. It comes in small steps. It'll be up 3%, and then the next day it's down 2%, and then it's up 2.5%, and then it's down 1%. You just don't know what the market is going to be doing on the next day. And as long as you're in it for that long-term growth that we see in the graphs historically, then you're probably making the best decision that you can. My advice would be, if you are concerned about the market and what it's doing, then it means that your risk profile, your personal risk profile, doesn't actually align with your current investment. So if you're all in on stocks, then that is something I would correct. I would go, okay, let me see if I should be looking at bonds or more stable assets that might not fluctuate as much. But you have to make that decision personally about where your risk lies and how much volatility in your portfolio are you willing to deal with, and the associated cost to that, not in cash, but making that money still work for you, just in a less risky, less jittery form. In summary, investors who stay invested over a long period of time in a diversified portfolio do so much better than those who try to profit from market turns or market movements. And it's nearly impossible to time the market perfectly. Even if you have perfect timing, you'll only come out ahead by a small amount. Selling out and going into cash also carries enormous risks, because you're missing out on those rebounds on that capital growth, and trying to figure out when to invest is a complete waste of time. Like, you're competing with funds that have billions of dollars to do this research, and it's ultimately speculation, and market timing is just so difficult to get right. If you are an average investor, and if you're looking for the long term, even 1 year, 3 years, 5 years out, you're still way better off investing in the market rather than trying to step out of the market, hold the cash, and hope that that you see an opportunity down the road in the future where you can put that money back in at the right time. And just remember, time in the market beats timing the market every time. Please support my channel. I will be putting out more videos like this. Subscribe if you want to catch those videos. If you have any questions or requests, please email me. And if you have a burning financial question that you would like me to cover on this channel, please let me know at financialbasicsabc@gmail.com. Goodbye.